Welcome, Market Rebels! Last week we found that if charts are just pictures, then prices are not about who's right. They're about who everyone thinks everyone else will agree with. Today you're going to find out why markets move on perception, not truth. Bulls, bears, and beauty pageants. Bulls think the price is rising. Bears think it's falling. The stock market isn't a battleground of prices. It's a battleground of opinions. Every trade is made by people, armed with the same information, arriving at strikingly different forecasts. Some expect momentum, others think volatility. If the information is the same, why do some opinions go off in different directions? In 1936, famed economist John Maynard Keynes was trying to answer a similar question. Why are financial markets so volatile? His answer came from a very unlikely place, a beauty contest in a local newspaper. Beauty pageants and financial markets. In the 1920s and 1930s, several British newspapers introduced a different kind of competition, still based on opinions. A grid of faces was printed, and readers would select the 6 they believed would be the most popular among the other entrants. A cash prize was awarded to the entrants whose picks matched the most popular selections. Most people think the contest is about selecting the ones you think are the prettiest. But Keynes realized it's not a beauty contest, it's an expectations game. Why? The key to winning isn't about picking your favorites. Instead, you must pick the faces you think most people will pick. That's an entirely different game. The contest is about guessing expectations. But it's even more difficult than that, as you must judge expectations of expectations, which are just varying levels of thought about what others think. For instance, level 0 thinking, I pick the faces I like. Level 1 thinking, I pick the faces the average person will like. Level 2 thinking, I pick the faces that others think the average person will like. Level 3 thinking, I pick what people think others think the average person will like. And the list can go on, depending on how far you want to guess others will go. Keynes realized financial markets are volatile for the same reasons. They're dominated by expectations of expectations rather than long-term fundamentals. Prices swing not necessarily because fundamentals change, but because people try to guess what others will guess. That produces self-reinforcing volatility, herding behavior, and waves of optimism and pessimism, and that's why prices overshoot or undershoot intrinsic value. Analysts can confidently shout all day long what the price should be, but anchoring your analysis to that number isn't going to make you any money. Everybody knows that number, as well as all other public information. And you can't beat the averages by doing what the average trader is doing. The traders who make the money are the ones who correctly guess just how far the average person will guess about the average person. So the same strategic thinking applies to markets. Level 0 thinking, I think this stock will go up. Level 1 thinking, others will like this company after earnings, so I should buy today. Level 2 thinking, others think traders will like this company after earnings, so expectations are already priced in. So I'm going to sell into the rally or fade the market. Level 3 thinking, the fade is obvious, so others will fade the fade, so I'm going to wait for the pullback to buy and rejoin the momentum. Each level justifies a completely different outlook, even though traders are looking at identical data. Financial markets aggregate expectations. The price of a stock, option, or bond isn't a pure reflection of intrinsic value. Instead, it's the equilibrium point where a vast number of traders with different outlooks, strategies, risk tolerances, financial constraints, and time horizons collide. This produces varying outlooks even when everyone sees the same information. However, Keynes's beauty contest logic explains how opinions differ, but in the financial markets, opinions can diverge for other reasons too. traders are playing different games. Different games create different incentives. Traders react to the same information, but they have different incentives. For instance, traders have different time horizons. A momentum trader looking at the next 30 minutes forms a different outlook than a value investor looking at the next 3 years. Risk tolerances also play a role. Some traders are risk averse while others are risk neutral. So if a coin is flipped for a $100 reward, risk averse traders may bid $40 to play, while a risk neutral trader may bid $50. Both are rational within their frameworks. They're just playing at different layers of the beauty contest because they anticipate different reactions from other traders with different risk appetites. Different beliefs of how markets operate will also change views. Some traders think that markets trend while others anticipate a reversal. If you believe markets typically mean revert, but believe others believe this trend will continue, you should buy. Processing speeds also affect which game you're playing and which price you're willing to pay. A quant fund operates in milliseconds, 1/1,000,000th of a second. Long-term investors may take hours to process the same information. Different constraints play a role too. If you're a money manager, you'll likely make a different decision than if you're trading your own money. Even if it is your money, trading in a taxable account can create different incentives than if you're trading in your Roth IRA. One trader may buy shares but hedge downside risk, while another trader may buy shares and sell off upside gains. Same information, different trades. The same could happen for the beauty contest. Imagine some contestants trying to win the top prize, others aiming not to embarrass themselves, and others simply trying to avoid last place. Same photos, different strategies. So when you see the price of a stock or option, you're looking at the crossing point of a network of beliefs. That's why two skilled traders can disagree on the trade, but both be right. One may believe the stock is overbought and sells, another agrees it's overbought, but also believes the rally will continue because they think that others think it will continue. It's the same information, but each is considering different levels of thinking. Most traders think success relies on prediction, but Keynes showed it's about anticipation. The market only survives on differences. In Keynes's contest, if everyone chooses the same faces, the game would collapse. Likewise, if all traders choose the same outlook, markets will freeze. Trading requires disagreement. Otherwise, you'd have nobody to take the opposite side of the trade. Outlook diversity creates price discovery, liquidity, hedging opportunities, volatility, trends, corrections, bubbles, and crashes. Paradoxically, you need varied opinions to make the market work. Different beliefs are the market. Keynes showed that once everyone knows the rules, the game becomes one of anticipation, not prediction. Most traders try to make markets predictable and orderly. If that were possible, you'd have no market. Always remember that competing in financial markets isn't about prediction, it's about anticipation. Yes, it makes it difficult, risky, frustrating, surprising, shocking, captivating, thrilling, and even rewarding. It's not the madness of crowds, it's the beauty of the markets. Next time, every market story sounds obvious after the branch snaps beneath your feet. We'll talk about the branches that never broke, the ones you never stood on, and why confusing a single outcome for the process that created it is the most expensive mistake traders keep repeating.